13 big tax changes coming in 2026 that could boost or shrink your refund. Big changes are coming to your 2026 tax bill. You have time to prepare for these changes now. The IRS released the 2026 tax brackets, and the One Big Beautiful Bill, OBBBA, brought sweeping changes. Some of these new rules might lower what you owe, while others might cost you a significant amount. The new rules touch everything from tips and overtime to childcare and car payments. Some breaks expire after 2028. Others will stick around for good. Whether these changes help or hurt depends on how you earn money and where you live. The IRS announced on October 9th that it's expanding tax brackets for 2026 to keep pace with inflation. The 7 federal tax rates stay the same, but you can earn more before moving into a higher bracket. Annual adjustments protect you from bracket creep, which occurs when inflation pushes you into a higher tax bracket. For example, a married couple earning $110,000 will now keep more of that income taxed at 12% rather than the higher 22%. The One Big Beautiful Bill, signed into law in July 2025, made many 2017 tax cuts permanent. Not all changes are equal. Some offer widespread benefit, while others have income limits and expiration dates restricting their reach. Many provisions from the 2017 Tax Cuts and Jobs Act, TCJA, were set to expire at the end of 2025. The OBBBA makes them permanent, including the current 7 tax brackets, a larger standard deduction, and the enhanced child tax credit. Without this extension, your 2026 tax bill would have looked very different. Brackets would have compressed. The standard deduction would have shrunk, and the child tax credit cut in half, from $2,000 to $1,000 per child. At the same time, the personal and dependent exemption, worth about $5,300 per person, would have returned. Lower rates and bigger deductions are now locked into the tax code, which makes long-term financial planning easier. But permanent doesn't mean unchangeable. Congress can still modify or repeat these rules down the road. Starting July 2026, parents can open tax-advantaged savings accounts for children under 18. They can contribute up to $5,000 annually. Employers can add up to $2,500 on top of that limit. The downside, you cannot deduct these contributions from income. Children born between 2025 and 2028 who have U.S. citizenship and a valid SSN receive a $1,000 deposit. All contributions must be invested in low-cost stock index funds, where they grow tax-deferred. You can't touch the money until age 59 1/2. Without paying ordinary income taxes, plus a 10% early withdrawal penalty. If your child qualifies, open the account now. Beyond that, consider better alternatives for college savings, such as 529 plans that allow for higher contributions and tax-free withdrawals. For retirement savings, custodial Roth IRAs offer tax-free growth and greater flexibility. 3. SALT deduction cap increases through 2029. The state and local tax deduction lets you write off what you pay in state and local income and property taxes. This deduction has been capped at $10,000 since 2018. Starting in 2025, the cap increases dramatically to $40,000 for most filers. To qualify, you must itemize instead of taking the standard deduction, listing all tax-deductible expenses. The higher cap is worth the extra work for more people in high-tax states like New York, California, and New Jersey. Previously, a single filer paying $25,000 in taxes could write off only $10,000, which was less than the standard deduction. Now, they can deduct the full $25,000, making itemizing more valuable. Married couples may not benefit as much from the higher caps. A married couple filing jointly shares the $40,000 cap. If they pay $25,000 in taxes, they need over $6,500 in additional deductions. If you live in a high-tax state and pay substantial state income or property taxes, run the numbers. Add up state taxes, property taxes, mortgage interest, and charitable donations. If the total exceeds the standard deduction, itemizing saves you more. The child tax credit increases from $2,000 to $2,200 per child starting in 2025 and adjusts for inflation annually. The credit phases out for higher earners, starting at $200,000 for single filers and $400,000 for married couples filing jointly. Roughly 24 million children benefit from this increase. However, millions won't get the full credit because their families don't earn enough. A married couple with 2 children must make at least $41,500 to claim the full $4,400 credit available. A single parent earning minimum wage gets about $1,900 per child, not the full $2,200. More children means a bigger gap. Middle-income families will see the biggest benefit. If your income is low enough, you might not benefit from the increase. If your income is too low, you might not qualify for the full credit. Earn too much, and the benefit phases out. Taxpayers 65 and older can claim an additional $6,000 deduction from 2025 through 2028, regardless of whether they itemize. The catch: this benefit phases out as income rises and disappears entirely at higher income levels. This deduction stacks with the existing senior standard deduction increase, ranging from $1,650 to $2,050 in 2026. A 65-year-old single filer earning $70,000 can claim the standard deduction plus the senior add-on and new $6,000 deduction. If you qualify, this $6,000 senior deduction reduces your taxable income for 4 years, which is especially valuable for IRA withdrawals. But don't factor in long-term retirement savings. It expires after 2028. Did President Trump eliminate taxes on Social Security benefits? President Trump promised to eliminate all taxes on Social Security benefits, but the One Big Beautiful Bill Act did not include that change. The actual rules for how Social Security benefits are taxed remain completely unchanged. 7 additional tax changes to watch for. The OBBBA includes several additional changes beyond the tax brackets and deductions that affect specific groups of Americans. The Republican bill introduces new requirements that make it harder to qualify for or keep Medicaid coverage. States now face penalties for high error rates, must check eligibility often, and have less money to fund programs. The Congressional Budget Office estimates about 7.8 million people could lose Medicaid coverage due to these changes. Supplemental Nutrition Assistance Program, SNAP benefits, are currently paused due to the government shutdown, causing food insecurity. Once the government reopens, SNAP will require more adults to prove they are working or actively seeking employment. Work requirements now cover adults ages 18 to 64 and parents whose youngest child is 14 or older. Exemptions for people experiencing homelessness, veterans, and former foster youth end. 4 million people could lose benefits. If you earn tips at work, you can write off up to $25,000 in tip income each year from 2025 through 2028. The break phases out at $150,000 for single filers and $300,000 for married couples filing jointly. 4. Overtime becomes tax-free through 2028. Workers earning overtime get a tax break from 2025 through 2028. You can write off this premium pay, the extra amount over your base rate, up to $12,500 if single or $25,000 if married. The break phase out above $150,000 as a single filer and $300,000 as a married couple filing jointly. 5. Car loan interest deductible through 2028. You can write off up to $10,000 in interest on a car loan, but with strict requirements. The vehicle must be new, assembled in the United States, purchased for personal use, and financed after 2024. The break phases down at $100,000 for single filers and $200,000 for married couples and disappears after 2028. Refinanced loans face additional restrictions, and lease payments don't qualify at all. 6. Charity donations deductible without itemizing. Right now, only taxpayers who itemize charitable deductions get a tax break, which most people don't do. Starting in 2026, people who donate cash can claim a deduction of up to $1,000 single or $2,000 married filing jointly. This works for cash donations only, not clothing, furniture, or other items you donate. 7. Child care credits increase in 2026. Starting in 2026, working parents who pay for daycare or childcare can claim a bigger tax credit. The maximum credit rate increases from 35% to 50% for lower-income families. Expense caps remain at $3,000 or $6,000. The credit phases down by income, starting at 50% for the lowest earners and gradually dropping to 20% for higher earners. Many tax changes are set to go into effect this year or in 2026, opening up opportunities for you to save money.
But they might also complicate your tax return. Here's how to prepare right now and get ahead of the busy tax season.
Use tax software that handles new rules. The best software updates annually, guiding you through questions about tips, overtime, and car loans. Track deductible expenses all year. Keep a folder for charity receipts, childcare invoices, and tip records now. If claiming SALT deduction, gather property and state tax details in one place. Organization now saves hours of frustration later. Do the math on itemizing versus standard deductions. The higher SALT cap and new charity deduction change the math for many people. Compare potential deductions to the standard deduction. Grouping charitable donations into 1 year might offer bigger tax savings if you are near the threshold. Know when to hire a professional. New rules get complicated fast if you own a business or earn income from multiple sources. A tax professional can model scenarios and show you exactly how much you'd save, paying off when software fails.
Update your withholding and estimated payments. New deductions for tips and overtime means some workers are overpaying right now.
Check your W-4 withholding to avoid giving the IRS an interest-free loan. Recalculate estimated payments to account for new deductions.